Tax Credit Opportunities for Historic Building Rehabilitations was a live webinar that was originally produced on Thursday, May 17th, 2018. For this webinar, we were joined by two of our team members here at McKonly and Asbury, Dan Kern and Mike Eby, as well as a special guest from Delta Development Group, Bonnie Wilkinson-Marr. We hope you enjoy this recap, and please visit us online at www.macpas.com for more information about our future webinars and other events.
There were significant restrictions on real estate investment with the passage of the passive activity rules and alternative minimum tax. And then we come up to 2017, we had roughly 40 years of the historic tax credit program, and the two-tier system is now down to a one-tier system that we have now. So we currently have the 20% credit. The credit is available to owners and long-term lessees of income-producing historic buildings. And the credit is taken when the work is completed on the owner's federal taxes. And with the passage of the most recent Tax Act and Jobs Act bill, the 20% credit, instead of being a one-time credit, is now a credit that is spread out over 5 years. So you're actually taking 4% each year for 5 years. There is a three-part application. The part one confirms that your building is historic. You can either be listed individually on the National Register of Historic Places or a contributing building within a historic district. And if you're individually listed, you don't have to do the part one. So that if you're in a historic district, you have to do the part one application. The part two describes the rehabilitation that you're going to undertake to a building, and it includes an extensive narrative, architectural plans, and photographs. And what the photographs do is that they document the existing condition that the building is in. So we're not talking how the building was originally constructed. We're talking about the pre-existing condition. While work is underway, if you need to make any changes or you run into unforeseen circumstances, you can submit an amendment and change how the rehabilitation will be undertaken. And then the part three work, when you're completed, you submit the part three and you basically say you've done everything that you said you were going to do. In order to qualify for this program, you must be historic. You must be listed on the National Register, either individually or as a contributing building within a historic district. The building must be used for income-producing purposes, so it must be a depreciable building. So, for instance, this could be a bed and breakfast, office, rental residential, a hotel, light industrial if you're in an industrial sort of building. So it must be a depreciable building. Thirdly, the rehabilitation must meet the Secretary of the Interior standards for rehabilitation. And these are 10 standards that were developed by the National Park Service in 1977 and have been the basis for this particular program since that time. And we're not going to go into the standards at this particular point in time. I can address some of those issues at a later date, or you can contact me and I can go over specifics with you. The fourth thing that you need to know is that the cost of the rehabilitation must exceed the adjusted basis of the building, and Dan will go into that in a little bit more detail. And then finally, you need to retain ownership of the building for 5 years after the credit is taken. And this is part of the regulations, and it's called the recapture period. So you need to retain ownership as part of that period. Otherwise, our friends at the Internal Revenue Service will come and visit you. And just to let you know that this particular program is really a partnership between the state, meaning the Pennsylvania Historical and Museum Commission, the National Park Service, and the Internal Revenue Service. So what will happen is that an application is prepared. It's submitted to the Pennsylvania Historical Museum Commission, particularly the Pennsylvania State Historic Preservation Office, who they do an initial review. They prepare review comments, and then they send it on to the National Park Service. The National Park Service has final review authority, and they issue the final part three, which is then included along with IRS Form 3468 when the credit is actually taken on your federal taxes. Now, there's also a state credit. It follows the same qualifications as the federal credit, but it's 25% of the qualified rehabilitation expenditures up to $500,000. The application for this, in addition to the federal application that you've already made, there's a single application, electronic application through the Department of Community and Economic Development. Each DCD region is allocated $600,000, and there are 5 DCD regions, so there's a total of $3 million spread over 5 DCD regions. The amount of the reservation that you will receive depends on the submission date and the number of applications per region, and it's really a lottery. So this last year, there were 72 applications that were submitted, and we really don't know how many reservation letters were going to be given out. But on the average, there's anywhere from 12 to 15. So if I'm not mistaken, in talking with staff at the Pennsylvania Historical Museum Commission, there were total project requests in excess of $56 million. So there's $3 million available for $56 million of requests. So we anticipate that there's going to be another application round next fall, and that will depend on the state budget.
And yeah, Bonnie, you kind of just really helpful walked us through the three-part process with the MPS. Which part of that MPS application would you say is the most challenging for developers, and why is that?
Well, I think probably the part 2, because the standards are just 10 very broad-based standards that are used to guide rehabilitation projects, and it's nothing that's very concrete. And the fact that each building is individual and no 2 buildings are alike, so it's really hard to pin down what's going to be approvable ahead of time. So there's a lot of unease until you get that final part 2 approval from the National Park Service.
But I had a question too, because this is one of the things why I refer clients to you when they're considering potentially historic tax credit deals. There's just things that come up that through experience and your best practices that you've seen hiccups in these deals. And when you're going through this planning process, considering whether a project would be a good candidate for a historic tax credit deal, and you're getting ready to do the applications, what are some of these things that developers really should know upfront before they get underway?
Well, I think one of the things that's really key for developers to know up front is to get your team together, your development team, so that it would include a historic consultant, a tax accountant who's familiar with historic credits, a tax attorney who's familiar with the historic credits, so that everybody knows right up front what all the rules are, and so that you don't go down the path and you've spent X number of dollars and all of a sudden you find out you can't do what you really want to do. So it's good to have your team together right up front so everybody knows what's expected of them and what your deadlines are going to be so that you know that right up front. Mike, so tell me, why would we want to bring an accountant in as part of our due diligence process?
Well, that's a really good segue to our next segment, Bonnie. Because I think you kind of, as you alluded to, you get going on these deals. The primary reason a number of times is there's a historic tax credit involved. There's actually cash available at the end of these deals. To your point, when you were talking about the history of before the historic tax credit was around, buildings were just being demolished and other things were coming up in that place. There was not an incentive really from a value standpoint for developers to be involved in these deals. So if you end up getting through these deals and for some reason not being able to take advantage of that tax credit, it's going to sour the entire deal. So you really don't want to put the cart before the horse. So why you would bring an accountant or specifically a tax CPA into the picture, these deals are often really appealing for a number of reasons. When you're taking the idea of taking a worn out sometimes unused building, and it might be located in an up and coming part of the city, particularly where an investor might have a personal or business connection to that city. They want to see buildings around their business or around their homes or community built up and restored to bringing life kind of back into these old buildings. That's very appealing. So that attracts a lot of people. Second part is you have developers that are very anxious to get these deals going because it's a very good way to bring in additional equity to a deal without costing those developers anything. And then third, the icing on the cake is really the federal and state tax credit. But you need to do your due diligence before signing on to these deals if you're an investor. As I said, there's several roadblocks that investors need to consider. Even if you can utilize this credit as an investor, if you're talking 8, 9, 10 years before you can actually fully utilize this credit, from a time value of money, it might not be much incentive to actually go through with that if it's taking that long, and it really might sour this deal for you. So as we're talking about some tax implications here, let's just give some brief background. As Bonnie mentioned, the 10% tax credit program has been eliminated. I've crossed that out there. I'm not going to talk really much about that because it is gone, but it didn't require National Park Service approval, but it was restricted to certain types of buildings that could qualify. So again, eliminated. Moving on to the 20% program. This was maintained under the tax reform bill. But when we get to the tax reform side, we'll talk about some changes on the timing of that. And Bonnie briefly mentioned that as well. From a realization standpoint, going forward, there will be a timing rule that will spread this credit out over 5 years. The credit itself can be realized against either personal income tax or corporate income tax, depending on who the actual end investor is. These deals are usually structured where the building is being held by a partnership. And then the individual investors or perhaps even C Corps, which include most banks, they would become owners in this partnership. And then from there, the actual credit, along with any operating activity of the entity, will flow through on a K-1 to the owners, the partners. And the credit itself is actually specifically allocated separately on a separate line item on the K-1. And it's based on the profit percentages of these owners in the partnership. We could probably take a whole webinar or two talking about 704B rules. Briefly, what that means is these profit percentages must have substantial economic effect, or the IRS is going to throw them out. Meaning you can't give an investor 50% ownership in a property or in the profit percentages. And like we said, the credit flows through based on the profit percentages of the entity. If they're not at risk for roughly 50% of the property, and at risk meaning they could have recourse liabilities, or commonly they've just contributed enough equity to get a fair 50% of the credit. Another key component there that I would point out is that the credit itself, let's say if it was a $200,000 credit, you actually have to reduce the basis of your building that you are putting on your books to depreciate for tax purposes. You have to reduce that by $200,000. So you might initially ask, what's the point of getting the credit if you have to reduce the amount of depreciation that you're going to end up getting? Simply put, credit is better than a deduction. Credit's a dollar for dollar payment against your tax liability. But secondly, really the value of the depreciation deduction that you're losing by the reduced basis, you're only recouping that over a spread of the life of the building, which for residential is 27.5 years. For commercial, it's 39 years. So even from a time value standpoint, it's not worth nearly as much as a credit that up until this point, through 2017, was available on the first year, but going forward, still even available over just 5 years. So, big question here. Can an investor realize this credit on their tax return? Really, probably the primary thing you need to consider when you're entering these deals. The first point there that I have 5. The first point though, consistent tax liability. This is kind of obvious, but if you don't have a consistent tax liability or a tax liability large enough to be able to utilize the credit, it's not a refundable credit, meaning it can only go against a tax liability. and that's obviously the first point there. But AMT was also a big factor prior to 2008. And Bonnie and I were talking about this before the webinar. This would crush a lot of deals because a lot of investors were consistently in AMT. And in 2008, AMT no longer became a barrier, so you were actually able to utilize a credit against AMT. There are some credits, and historic tax credit is a general business tax credit, similar to research and development tax credit. And when we have potential businesses that are involved in the research and development tax credit, for larger businesses, they are so restricted from using this against AMT, and that prevents a lot of them from going forward on R&D. And that was the same way at one time for the historic tax credit. So it's a very favorable change that's able to be applied against AMT now. As I mentioned before, investment has to be held at risk. Again, that's the 704B rules. Otherwise, the losses from the partnership, and more importantly, as for this discussion, the actual tax credits up front will get reallocated to a partner that is at risk in the partnership. And then active versus passive, we're definitely really getting into something here now. This is probably the biggest decision point now that AMT is no longer an issue, is whether the partner is actually, or the ultimate investor is active or passive. If you're passive, and real estate per se is a passive activity, it is tough to become actively involved in real estate. And we'll talk about one way around that. But the default, the IRS's default position is that investment in real estate is a passive activity, meaning your income and losses are considered passive. Your losses, people don't typically want passive losses because you can't utilize losses from passive activity, and you can only utilize them against passive income. Same way for the credits. So if you have passive credits, historic tax credits flowing to you, you can only use it against tax liability that's specifically generated from passive income. And if you think about real estate activities, so if you're putting this property in service, you're going to have operations income. Most likely, if it's a rental property, it's going to be either rental income or loss. But typically in the early years, you have a lot of losses. You're getting tenant build up, plus you have some accelerated depreciation depending on what certain components are in the building. It takes a little while to actually make income on the property. Plus, for instance, you have interest as well. That's a little higher in the earlier years. So unless you have a ton of passive income from other sources of activity, it might be a long time, or even maybe never, before you can utilize all or even a majority of the tax credits. So, actually, I want to make one key note about C corporations that aren't closely held. So think of our banks. A lot of financial institutions get involved in these deals from a community outreach standpoint, but also they're also able to utilize the credit. Passive activity restrictions do not affect C corps that aren't closely held, but definitely for individuals, something that they need to be aware of. So I mentioned the real estate professional is one way around this, and that's the fifth point there. This allows many investors that potentially to be considered active in a real estate, as long as they're materially also participating in that particular activity. And as I mentioned, where this is beneficial from the historic tax credit side, they can actually flow these credits through and they'll be considered active credits. And that allows you to utilize the credit against all sources of income. That includes obviously your passive income, but also your active and your portfolio income, which typically includes dividends and interest. So all of a sudden there, the credit becomes, the utilization of it actually becomes much more attainable. Kind of like the 704B rules though, that I highlighted before, we could spend a lot of time discussing what all is included under real estate professional status and kind of the hurdles around that. There's a couple key points though that I would highlight on that. There is an annual hour requirement spent on real estate trades to be a real estate professional, and you also have to spend a minimum annual hour requirement on each real estate trade materially participating. And a lot of real estate professionals then group their activities of all the real estate into one activity to be able to meet that threshold. You also have to spend over half of your working hours in a real estate field. So naturally, if you're in a different profession outside of real estate, you're not going to be able to rebut that assumption that you're not a real estate professional. So if you're a real estate investor, it's probably pretty simple to become or be classified as a real estate professional. But what a lot of people don't consider is that there are certain trades that aren't real estate investment per se, but they are related to the real estate field. For instance, if you are a construction contractor or if you're a realtor, that does qualify as a real estate profession in the terms of becoming a real estate professional. And that would possibly allow you to be active in your real estate investment activities. So let's actually talk about briefly here. I don't want to get into a lot of math here, but we want to talk about the credit utilization, how it actually looks on your tax return. So barring any other restrictions that I talked about before between at risk and active versus passive, if you're an investor with a high income tax liability, talking investors that have income tax liabilities over $25,000, you won't be able to utilize this credit against 100% of your tax in any given year. So even if you have enough tax credits that would theoretically wipe out your tax liability, if you're what I'd say a higher income tax liability individual, you're not going to be able to wipe it out completely. But at the very least, you will be able to, again, barring other restrictions, would be able to utilize the credit up to 75% or more of your tax liability. See how it works here. It's your regular tax, less your non-refundable tax credits. So think common ones like child tax credits, which has been expanded through the tax reform, and a lot more individuals will be getting that. Foreign tax credits that, when we say non-refundable, they can only go against tax liabilities. You can't get actually a refund with those credits. That's going to equal your net regular tax. Then we add your alternative minimum tax. So as you see there, A&T, we can use the credit against that. And then we have to take out 25% of your net regular tax that exceeds $25,000. Kind of hard to wrap your head around it, but let's put some numbers on that. Again, if you want to see more detail on this, if you enjoy seeing how taxes get utilized on your return, I would point you to the Form 3800, and you can walk through the calculation on that form where all general business tax credits are utilized. But let's say in this scenario, this individual investor has $75,000 of historic tax credits available. They have a total tax liability of $50,000, so net regular tax after credits of $45,000. And then this investor was slightly in A&T, so they had about $5,000 of the A&T. Then we have to take 25% of your net regular tax that exceeds $25,000. So 25% of $20,000 equals $5,000. So ultimately, we can utilize up to $45,000 of historic tax credit in this current year. The $50,000 total tax liability less that $5,000 exclusion. So the taxpayer must still, in this case, pay $5,000 of tax liability, but they were able to negate 90% of their tax liability. And then the remaining 30% of the tax credit is then carried forward to a future year, and the same process and calculation will occur in that future year. Some, I guess, I would say miscellaneous tax items that we've considered before we get into tax reform. There is a 5-year credit recapture period, which I believe Bonnie mentioned in her part of the presentation. And this is if the ownership of the partnership is not maintained, or let's just say even if the partnership were to sell or dispose of the property itself within 5 years. The Recapture is based on a 20% pro rata amount each year. So if you got $100,000 of credit for each year you aren't in the partnership up before 5 years, you could lose 20% a year of that credit amount. So for an example, if an investor were to pull out a deal in year 4, they completed 3 years of that deal, so only 2/5 of the credit be recaptured, or in other words, 40%. There's usually an agreement in place to buy out a limited partner after 5 years or some other agreed upon time frame. This is particularly true when an investor it could be a tax credit partnership or even a bank that's not necessarily tied to the community directly, ones that aren't very interested in the income operations of the property. They want to get out after the minimum 5 years. So this would be where attorneys come into play, and they have these deals in place to know exactly what the buyout and exit plan would be. You can't use the credit all in 1 year. It's a 20-year carry forward for individuals, 1 year carry back. And if you don't use it in 20 years, it becomes deductible. Okay, not a credit, but a deduction on the last year of your carry forward. But if you're getting to 20 years down the road, that credit really has become much less valuable to you if you had to wait 20 years to fully utilize it. So you don't want to be in that case no matter what. There is some, we up to this point have talked about regular tax credit deals. There is a much more complex deal structure. It's called the master tenant structure. I'm not going to talk a lot about that. It's very unique, but it does come into play and as useful in certain situations. And the reason it's unique, it's because the actual tenant of the building, a long-term tenant, can actually receive the credit instead of the owner of the building. So in turn, a phantom asset and liability are placed on the balance sheet of the tenant's tax return, and the tenant then recognizes rateable income on that phantom asset, which actually is the credit amount. And this is kind of in place of, as we talked about before, when you have a regular tax credit deal, the building basis is reduced by the credit amount, meaning that the depreciation ends up being less over that time span of 27.5 years or 39 years. This is an income pickup, but it's doing the same thing. But since the building owner in this case isn't getting the credit, they shouldn't have to pick up the income. It's actually the tenant in this case. Like I said, there are some advantages to this type of deal, including being able to potentially bring nonprofits into the deal in some certain cases. I would warn you ahead of time, though, you will incur more attorney fees. I would say especially attorney fees, but CPA fees as well. There is some additional items that need to be considered when you're going to these type of deals. So now tax reform. How does this all play into it? As I mentioned before, tax credit for the 10% program has been repealed. 20% tax credit was retained, but it's now recognized over a 5-year period instead of all in the first year that the building is placed into service. So essentially, you're getting 4% tax credit each year. There are some transitional rules to this. What I would also, in other words, say grandfathering provisions that would allow you to still get this credit all in 1 year. First one, you need to have the building must have been owned, or in the case of, like we just talked about, the master tenant structure, leased by that party as of 12/31/17. And then the ownership must not change after that either. And then the beginning of your 24-month rehab measurement period, it's kind of the first time we're talking about that. Dan will elaborate a little more on that later. That must occur within 180 days of when the tax reform bill passed, which was December 22nd of 17. So that date, the 24-month period, must begin by June 20th, 2018, so next month. Important thing to note, though, that does not mean that the actual physical rehab construction work must begin by that date. That's purely a measurement date for making sure that substantial rehabilitation has occurred, which is a major test for meeting the historic tax credit requirements. So if you have a 1-year project, you conceivably could start that in 2019 and wrap it up in early 2020, and you'll look back 24 months, and that would put you before June 2018. So you're good under the grandfathering rules as long as the building was owned by you as of 12/31/17. In fact, you can actually incur costs because you can take all the costs after the building's placed in service up through the end of the tax year. You could still meet the grandfathering rules and still be accruing qualified rehab costs for historic tax credit up to December 31st, 2020. So there is definitely still opportunity to get same credit amount, but being able to recognize it all in year one potentially instead of over a 5-year period. And that window is obviously quickly closing.
Well, and the key to that is to own it by December 31st, 2017, last year. That's sort of the key threshold in that.
Absolutely, yeah. If you don't own the building yet, you're not gonna be able to meet those grandfathering rules. Those are some of the direct effects of tax reform on the tax credit, but just some, I would say, indirect ones that I think are going to come into play. The overall tax rate has reduced for particularly C corporations. It went from a 34% rate to marginally to a 21% flat rate. So a lot of your banks would actually fall into this category. Individuals will also benefit from a smaller rate reduction. However, a lot of individuals may qualify for what is the 20% qualified business income deduction. So what this effectively does, if their income does qualify for that, they'll go from a highest rate of 39.6% down to potentially 29.6%. So they're looking at maybe 10% reduction in taxes as well. Not as much as a C course, but still a pretty good drop. It doesn't affect, it's a tax credit, so it really doesn't affect necessarily what you're getting in value in return, because a dollar of credit is a dollar of tax no matter what the rates end up being. Where it might have, I guess, some negative effect potentially on the industry, there's just might going to be maybe less demand for this particular tax credit. As I said, banks are ones that really heavily get involved in these deals. Banks were one of the biggest winners from tax reform. Typically, most banks, if they don't have a lot of foreign operations, a lot of banks, local banks, they're paying the highest tax rate in the U.S. So all of a sudden, they're paying 13% less tax. They need less credit programs to abate their taxes. And same thing for some individuals. There's also going to be some interplay with the reduced recovery periods for qualified improvement property. Default, most commercial property, non-residential, I should say, it's depreciated over 39 years. Now a lot of property will be eligible, a lot of rehab property would be eligible for 15 years. So there is going to be some faster recovery time on depreciation going forward. And that may, in some cases, attract investors from that standpoint, just from an operations play. And then lastly, on the tax side, we talked or focused really up to this point mostly on the federal tax credit. Just turning briefly to some state tax credit opportunities, and specifically we practice primarily in Pennsylvania, and our audience, as we look at the attendee list, is primarily out of Pennsylvania here. Pennsylvania offers a 25% historic tax credit, and Dan's going to talk a little more about that. Bonnie's already touched on it. It's limited to prior approved cap for a specific project. Federal government has the ability to not have a balanced budget, meaning they don't have to restrict how many historic tax credits they can allocate to any business. So all your qualifying rehab expenditures will be fully eligible, non-capped, and there's no max for the overall program. Pennsylvania has a max overall for the program for all businesses in any given year is $3 million. And as Bonnie mentioned earlier, a max per business of $500,000. For those particular projects, they might incur much more, if you're talking $500,000 max credits, that would be $2 million of qualified rehab expenditures. Those projects might incur much more than that, but they're going to be limited on how much they can get. So better credit rate, but unlike the federal, it is capped. It can be utilized against Pennsylvania personal income tax, corporate net income tax, bank shares tax, some other novelty taxes such as insurance, premiums tax. There's a 7-year carry forward period, no carrybacks of credits allowed in Pennsylvania. And you can actually sell or transfer the credits. You might hear the term selling credits at the federal level. That's not a true sale, but in Pennsylvania, it is a true sale. You will actually be able to transfer this credit to an unrelated party and receive compensation back from that other party. In addition to always having the option to pass through the credit to an owner of a pass-through entity as well. There is no waiting period before the sale. I say that with a little caveat. Some restricted credits in Pennsylvania require you to wait a year or file a return before selling. So there is no waiting period. You could sell it instantly, but it does require Department of Revenue approval to you submit an application to actually sell the credit. There is some lag time on that, maybe 5 to 6 weeks before the credit actually sale is approved. This is one of the best credits from an overall buyer-seller standpoint, and the fact that the buyer can utilize the credit against 100% of his tax liability. But once the credit's actually purchased, the buyer can no longer carry it over, or pass it through, or transfer it to another party. So they need to make sure that they can actually utilize it fully in the year they purchase. And there are some federal and state income tax considerations from the income side related to capital gains, because this is a capital asset when you're talking about a tax credit sale. So there will be an income pickup for the seller. And that's Pennsylvania. There are 33 other states that have some form of state-specific version of the historic tax credit deal. And they're changing. A lot of them changing rapidly. I think Bonnie and I, you were talking earlier, there's probably 2 or 3 states that have had significant modifications just this beginning of this year on their programs. So definitely something to consider as you're entering one of these projects. You already know about the federal credit program, but there might be a state credit program that could piggyback off with that on the federal side as well. So that's tax. I'm going to turn it over to my audit colleague, Dan. He's going to talk about where cost certification come into play for historic tax credit.
Yeah, thanks, Mike. And we'll run through the process of cost certifications, what they entail, both at the state level and specifically, I have Pennsylvania there. We'll be talking strictly about Pennsylvania today. As Mike said, there's 33 other states that have their particular rules and laws surrounding what needs to be done, but we'll be considering Pennsylvania here. At the state level, a certification does have to be performed by a third-party independent CPA firm. You can't have a certification done by your in-house accountant, sorry. It must be done by an independent third party. And I'll just note there that it doesn't preclude the CPA firm doing the cost cert, also doing the tax work as well. The firm could do both the tax work and the certification. So essentially, if an award is made in Pennsylvania by DCD, then you will be required to file a cost certification with DCD and PHMC by the end of the project. And what does it entail? What does the cost certification entail? Well, it's verification of, and we'll start using this term, and I'll explain it in the next couple of slides, QREs, or qualified rehabilitation expenditures. It's a verification of QREs by the examination of invoices, canceled checks, settlement sheets, contracts, agreements, and related documents. Essentially, what we're trying to do there is confirm the legitimacy of the costs. And for both existence, do they exist? And for classification, do they count as eligible basis, or are they another sort of cost, acquisition, syndication, costs that, as we'll talk about, are ineligible costs? We'll make inquiries of management in order to gain clarifications. One example of that would be legal fees. If you get legal invoices and we can't tell what type of legal fees they are, we would ask, hey, are they acquisition related? Are they development related? Are they syndication related? Another example would be cabinets. The difference between bathroom cabinets and kitchen cabinets is the difference between a qualified rehabilitation expenditure and an ineligible cost.
And I think an interesting point when you do these type of cost certifications, this is kind of the opposite of a cost segregation. Cost segregation has you're trying to get these assets broken down into tangible personal property as much as you can to get a faster recovery period. We're doing the opposite here. We're trying to find any way possible to get these into a part of the real estate because the credit's only available for real estate. So it's a reverse thinking of what most people do when they're thinking of a cost segregation project.
And that's a great point, Mike. And especially when it comes to federal purposes, we want to get the highest number of qualified rehabilitation expenditures as we possibly can, because that's going to be the basis for the credit number. And there is no cap at the federal level. So we want to get as many costs as we possibly can. Just a couple of notes here as well. This is on the accrual basis, and we want to ensure that the partnerships or whatever entity we're dealing with, that the accounting is done on the accrual basis. Sometimes we'll see the books on a cash basis, and a great example that I love to use is the developer fee. Well, by the end of a project, by the completion date, not all the developer fee is usually paid out. However, it has been incurred. So we want to make sure you're booking that and you're getting credits to build that into your basis for credit purposes. As was noted, at the state level, this does calculate a 25% credit. It is capped by DCD at the reservation letter amount, and I'll give you an example a little bit coming up. At the end of the project, the certification must be filed with PHMC, DCD, in order to obtain a tax credit certificate. That tax credit certificate is really, really important, especially as Mike said, you can sell the credit. You want to have that tax credit certificate in hand. You'll have to have it in hand before you can sell. And also to point out, and I think Bonnie alluded to this already as well, for each project in the Commonwealth, you can get a max of $500,000 of credits per project. $3 million total is allocated per year. And as was mentioned, the awards have not been made for the 2018 round yet. At the federal level, a certification is not required by a CPA. However, I will say that often it can be requested. It can be requested because it acts as a quote-unquote insurance policy. We'll hear from developers many times that they want to go through the cost certification process because, hey, in case of an IRS audit, they want to sleep easy, knowing at night that a CPA has examined all the costs and that it just gives them that additional level of assurance that everything's going to be okay. It's going to include the same things: verification of invoices, looking at settlement sheets, that sort of thing. Again, it's on the accrual basis, and different than the state credit. Different than the Pennsylvania state credit. Instead of a 25% credit, we're looking here for federal purpose is at 20%. There is no cap. So again, every dollar counts. We want to make sure if we're looking at your records that we're asking those detailed questions so that we can make sure that QREs are built up appropriately so that you can get the max credit possible.
I would say I've personally never encountered a federal IRS audit on a cost cert for a client. But I would say if there is one, the IRS would definitely appreciate a cost certification study, because this is an independent review of the process. Whereas even though it's not required, an internal, someone who's a non-CPA might be a little too aggressive on some of the credits. So having a true independent third-party study would certainly provide some protection under audit. That's my opinion. But again, I've never had that issue, but if you have, or if you do encounter that issue, I would certainly feel much more comfortable with one of those in hand, right, than not.
Just to help you sleep a little bit easier at night, I would say. We talked a little bit about QREs, these qualified rehabilitation expenditures, and just a layman's definition of that. In general, QREs are only those costs that are directly related to the repair or improvement of structural and architectural features of the historic building. So a lot of times we'll describe this as costs within the envelope of the building. And there's two parts of the eligible costs, both the hard costs and then soft costs can be eligible as well. The hard costs being things such as walls, partitions, floors, glued-in carpeting as opposed to tacked in, which we'll talk about in a second, ceilings, windows and doors, HVAC systems, plumbing fixtures, electrical wiring, chimney stairs, and a myriad of other things. And I would even say this list is not exhaustive. I would say certainly touch base with your accountant to determine whether or not some of those gray areas, what to do in those situations.
Oh, for instance, if you were going to put in a geothermal system, the geothermal system itself would be an allowable cost, but the site work to cover up the geothermal system would not be an allowable cost.
Yeah, and that's a great example, Bonnie. Like, so many of these situations can be gray areas, and that's why it's best not to go into these by yourself. You want to go in it with a trusted advisor, a trusted accountant, a trusted lawyer, so that you can cross all T's, dot all I's.
So Dan, obviously an enlargement to a building would not qualify as qualified rehab expenditures. I think the term that often used is outside the envelope. It wouldn't count. How about things like internally, like demolitions or partitioning of walls within the actual envelope of the building? Would that potentially qualify as qualified rehab expenditures?
Yeah, it's an important distinction to make. Additions would be qualified rehabilitation expenditures, but enlargements would not. So if within the envelope of a building, if you're subdividing or you're partitioning, you're doing internal demolition, those would be available to you as QREs. If you're doing an enlargement, you're adding onto the building, you're creating an additional floor that wasn't there originally. You got to be really careful because those costs would not be eligible. So, helpful distinction to make there.
I just want to point out that you talk about interior demolition of walls. You need to be really careful how many of your walls that you demolish, because the National Park Service considers floor plans and some existing walls are significant. So per the IRS regulations, you can only typically demolish 50% of the interior walls. And then you have to take into consideration, are some of those walls historic and their removal would affect the floor plan. So that's why a historic consultant is necessary up front. But this sort of leads me to ask, if I were to obtain a federal or state cost certification, what steps do I need to take now?
Yeah, and it's kind of been the theme of what we're talking about here, but you want to have your team in place early on. You don't want to get 6 or 8 months in the rehabilitation and determine that you need an accountant, that you need an attorney. So for the question that you asked, Bonnie, certainly if you think that you might need a certification, get your consultant involved, get your historic consultant involved, ask them who they recommend in the region, who's good at doing this kind of stuff. And certainly, we're doing this webinar. McKonly and Asbury is co-hosting it. Feel free to call or email Mike or I, and we can help as well. But the biggest thing I would say is the goal is to get these things set up early so that you're not trying to do them last minute.
I know we're right around 50 minutes now for our presentation, which I know some of you are interested because that meets the CPE requirements. There are a couple of case studies that we want to get into, and I know there's a couple of questions, so we don't want to rush through. There's some interesting things on the case studies, so we aren't going to necessarily rush through those, but I did want to point that out that for those of you that are purely interested in CPE at this point, we have met that requirement. But I'll turn it back over to Dan there as he's finishing up his part before we get into the case studies.
And not too much to mention here, but just to point out, this is kind of the structure of what a cost certification would look like for you on the right-hand side of this slide. And just some important things to be aware of. Be aware of large ineligible costs, such as the acquisition itself. Be aware of site work, furniture, things that are not going to be eligible costs. You don't want to get far along in the construction and think that you're going to get credit for something that you end up not getting credit for. Keep it within the envelope, and then dig into the details. We talked about cabinetry. Well, is it bathroom versus kitchen? Bathroom cabinetry would be eligible cost, but kitchen cabinetry would not. Flooring, is it, like we talked about, is it tacked in or is it glued? Signage, is it signage that's detached from the building in front and as part of the site work? Or is it attached to the building and it's used to enhance the historical nature of the building itself? These are important questions that you need to ask or touch base with your accountant, your consultant with to make sure that everything's on the up and up. And just some quick examples you'll see on the left-hand side, federal example, on the right side, your PA example. You have total QRE on the left-hand side for federal. You multiply it by 20% to get your max federal credit of $3 million. And that's not capped. What is calculated is what you'll get. On the PA side, the difference is it is a 25% credit, not a 20% credit. And although the state max HGC there says 3.75 million, you are still subject to the state cap in your DCD reservation letter. So say you get a DCD reservation letter that says you are capped at $150,000 of credits, you will get the 150, not the 3.75 million. It's an important distinction to make. And just at the bottom there to note real quick that QREs could be different at the federal and state level. I won't go too much into that, just to say that the timing of the cost incurred is a factor. Pennsylvania at least sets a date at which costs can be incurred at, and from that date onward. For instance, in your reservation letter, it could say you may not count costs towards QREs after July 1st, or I'm sorry, before July 1st, 2017. So there could be a timing difference there between your federal and your state QREs. And just finally to note, there's a substantial rehabilitation test that Mike alluded to, and this is required to meet the rules of the historic tax credit program. It is a pass-fail test, and it needs to be met during a measurement period. There is a 60-month measurement period for multi-phase projects. For purposes of this slide here, we're only dealing with the 24-month period of single-phase projects, but it must end within the tax year the rehab building is placed in service. So for instance, you could have a measurement period from January 2016 to January 2018, and then placed in service later that year, say in August of 2018. That you would be within the scope of the rule there. And just to note that this measurement period can be adjusted during the course of rehabilitation. The actual test is that total QRE incurred during the measurement period must exceed the greater of $5,000 or the adjusted basis of the property, excluding the land value and taking into account depreciation and land improvement. So that's certainly a test you want to be aware of and talking to your accountant about to make sure that there's not going to be any holdups with meeting that test.
Yeah, you want to make sure you do it up front, because when you go to take the credit, the IRS is going to ask you, what is your adjusted basis right up front? So you need to know, that's going to be one of the first things you're when working with your accountant, that you really want to determine what is going to be your adjusted basis, that you need to know what your threshold is going to be. Because sometimes, the cost that you're going to incur would be less than your adjusted basis, and you may not qualify for the historic credit. So you really need to know what that adjusted basis is right up front.
Yeah, and excellent point, Bonnie. Yeah, thank you.
Yeah, if you're seeing a theme here, being proactive, and getting the right people involved up front. I think if you take anything away from this today, there's a lot of details, but if you had to summarize it, that would be the thing you want to take away from this today, is because we talk about this.
Yeah, be proactive and make sure you have the right team in place. And then just a final note there. This is a final note, but it is kind of important that QREs incurred outside the measurement period can still qualify for the historic tax credit. The same example, say that the measurement period is from January of 16 to January of 18. You place in service in August of 18. You can technically still accumulate your qualified rehabilitation expenditures through the end of that calendar year. So in this example, up to December 31st, 2018. So really key that it's not just that you accumulate QREs during the measurement period, you can go beyond that as well.
Yeah. I've just got a few quick case studies. This is the Curtis and Jones Shoe Factory. This was an industrial building that was not in a historic district, so it had to be individually listed on the National Register. It was constructed in 3 different phases. It was operated as a factory until 1973, and then it was part of the Reading Outlet Center until 2001, when lack of maintenance, the roof deteriorated and collapsed onto the 6th floor, which collapsed out onto the 5th floor. So the owner was using funding equity from both the historic tax credits and the new market tax credits to put equity into the building. Floors 1 and 2 were used for commercial purposes, and residential on floors 3, 4, 5, and 6. They were 65% done with the rehabilitation, and there was a 4-alarm arson fire. And this is not something that you want to have happen. The owner decided to go forward with the project and finished up the project and got his tax credits on December 15th, 2016. He utilized both both federal and state tax credits for this particular project. So source of funds was equity. He had a mortgage. He had equity from both the federal and the state credits, and he used new market credits. He also used a Berks County Capital Investment Housing loan as part of the project. So that was a $15 million project. And you can see the start of the project on the upper photograph, then after the fire, and then next slide. And there's the completion. So when he was looking for the equity for his project, was able to sell his tax credits for 97 cents on the dollar. The new market credits brought 82 cents on the dollar. So figuring out that particular. Schmucker Hall is a contributing building within the Gettysburg National Battlefield Historic District. It was originally constructed as a dormitory. It is owned by a nonprofit entity who is part of the master lease agreement that Mike talked about. Since nonprofits can't use historic tax credits, they were able to syndicate the credits. It is now a for-profit museum. Has to be an income-producing use, so it is a for-profit museum. And this is, next slide, had a number of different sources of equity for the project. It had a line of credit, it had a bridge loan, it did use state redevelopment assistance capital program grant. There was a PennDOT grant, and it had a federal grant for scenic byways as part of the paths leading up to the building on the outside, and it used both historic tax credit equity and new market tax credit equity. Tax credits for Schmucker Hall sold for 98 cents on the dollar for the historic, and for new market, they sold for 74 cents on the dollar.
And these are the cool things about historic tax credits. Dan and I were involved in the numbers Bonnie, you get out to the sites a little more than we do, but these are all things that we're familiar with in our community. If you're a Civil War buff, you've been to Gettysburg, you've probably driven right by there. Just knowing the history and how these programs, how these rehabs actually were possible through tax credit programs. We actually have several questions, and we are right around 3 o'clock right now, so I want to be conscious of people's times. I do promise one of us will be getting back to each one of your questions. There's just a couple that I highlighted that I thought might be beneficial for the group as a whole. I think the first one applies to me. I've heard developers discuss selling the federal credits. What does that entail? I would say selling is actually you put that in parentheses or in quotations, because selling the credits, it doesn't really occur on the federal side. You have to actually come in as a partner and contribute equity. Truly you are getting, the developer then is getting some benefit for those tax credits without having to actually pay for that. So there is, in theory, kind of a sale going on, but it's through an equity. Unlike Pennsylvania, that tax credit can literally be sold after it's obtained. Bonnie, I think the second one that we'll go over, I think this applies to you. If we have a potentially qualifying building for historic tax credits, is it necessary to use a consultant like Delta to coordinate the application process?
No, it's going to depend on the complexity of your project. If you can certainly prepare the application yourself, but by getting a consultant to help you through it, that you can upfront know what your hiccups are going to be, what you're going to need to encounter. Certainly there's certain rehabilitation issues that cause the National Park Service a lot of angst. One of those is window replacement. And it's the moniker that because this is a program to maintain the historic character of a building, that's what you're really doing as part of this project. You want to repair rather than replace, and if you have to replace it in kind. So, that's sort of the thing that you want to think about, and that's what the historic consultant can do for you. There's also another question on historic districts. Are they urban? A rural stone farmhouse from probably the 1800s, probably not included. There are rural historic districts. There is a rural historic district. For those individual stone houses, you could get those individually listed on the National Register in order to qualify for this particular program. And the same could be said for a farmstead. If you were to use the stone house as rental property, because you can't get the tax credit for a privately owned residential. It has to be a depreciable building. So therefore, there's a number of historic districts. Certainly, the city of Philadelphia has over 61 historic districts. There's historic districts in the city of Pittsburgh. The city of Harrisburg has 7 historic districts. Practically all the city of Lancaster is a historic district. There's a number of historic districts in the city of York. There are historic districts in smaller municipalities, but for the stone house that is on a farmstead, you could go ahead and list the farmstead on the register, and you could certainly for the barn get a tax credit for use of the barn as a barn, or if you were to turn it into an event venue, et cetera.
Yeah, so it's worth asking the question.
Yes,
it really is. Dan, I think I know the answer to this last one that we'll answer on live here, but I'll let you. Who in Pennsylvania, and I assume this is referring to as a service provider, a CPA, who can do cost certification?
Yeah, you're right. I guess we're kind of biased in this room. I mean, McKonly and Asbury can obviously do cost certifications. And I'm biased, but I truly believe that we have the team in place here, both on the tax side and the attest side, that can help meet the needs of any developer that's willing to undertake one of these projects. We have the experience doing it. But, in general, I would say consult with your attorney, consult with your historic consultant.
I mean, certainly I can't do a cost certification, but
you might know.
But certainly, if you're a qualified accounting firm that knows the particulars on what are the qualified expenditures, and the IRS regulations, then you could prepare one. And certainly, I've worked with both of you to do cost certifications for a number of state certification projects, because they're not necessarily required for a federal project, but they certainly are required for the Pennsylvania Historic Preservation Tax Credit.
Yeah. Yeah. And what we've been finding in the last several years since the state-specific credit program came out is a lot of firms they don't do these studies. Our firm was built on affordable housing, the low-income housing tax credit, which we did a lot of these type of studies for that particular credit, very similar than for the historic tax credit program. So a lot of investors, a lot of developers, they might not be using McKonly Asbury as their regular accountant, but we're getting quite a few of them that are using us then for their third-party cost certification study. With that, we do have a few other questions to answer, but like I said, we'll get back to those specific individuals that ask those questions after the webinar. We do also have our contact information. Please don't hesitate to reach out to us. If you've kind of gotten the idea of the webinar so far, there's a lot of case-specific scenarios that come into play. Just ask the question, and we'd be certainly happy to get back to you. And if you ask one of us the question and we're not the right parties, one of the three of us,
we'll forward it on to the right person.
Exactly. So again, I appreciate everyone's time.
Thank you once again for joining us for this webinar recap produced by McKonly and Asbury. We hope you join us for all of our future webinars, and you can stay connected to us and learn more about all of our upcoming events by visiting www.macpas.com. Thanks again, and have a great day.